Good morning, ladies and gentlemen. Welcome to the Six Flags second quarter 2023 earnings conference call. My name is Drew, and I will be your operator for today's call. During the presentation, all lines will be in a listen-only mode. After the speaker's remarks, we will conduct a question-and-answer session. If you have a question at that time, simply press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, please press star then 2. If you require operator assistance, please press star then 0. Thank you. I will now turn the call over to Evan Bertrand, Vice President, Investor Relations and Treasurer.
Good morning, and welcome to our second quarter 2023 call. With me is Selim Bassoul, President and CEO of Six Flags, and Gary Mick, our Chief Financial Officer. We will begin the call with prepared comments and then open the call to your questions. Our comments will include forward-looking statements within the meaning of the federal securities laws. These statements are subject to risks and uncertainties that could cause actual results to differ materially from those described in such statements. And the company undertakes no obligation to update or revise these statements. In addition, on the call, we will discuss non-GAAP financial measures. Investors can find both a detailed discussion of business risks and reconciliations of non-GAAP financial measures to GAAP financial measures in the company's annual reports, quarterly reports, and other forms filed or furnished with the SEC. At this time, I will turn the call over to Selim.
Good morning. Thank you for joining our call. Today, we will focus on 3 areas. First, I will provide an update on the progress we have made on our transformation. Second, Gary will provide details on our financial results and our outlook for the remainder of the year. Finally, I will return to discuss our 4 key strategic pillars for sustainable long-term profit growth. Our team continues to work hard to transform the company as we strive to reach our full potential. Any transformation begins with a vision for what the company can be. For us, our vision is to deliver a truly exceptional experience for our guests and sustainable profit growth over the long term for our shareholders. The hard work is turning that vision into a reality. Despite a challenging weather backdrop, we saw a solid growth trajectory in second quarter and first half of the year. There are 5 items I would like to highlight that serve as indicators that our transformation is taking hold. First, our guests are responding favorably to the investments we have made in our parks, in our new seasonal events, and in technology, including our new mobile app. Second, our season pass sales trends continue to be strong. Year to date through July, our season pass unit sales have increased over 50% versus prior year, including the newly released Six Flags Plus subscription offering. After a slow start to our 2023 pass sale last fall, guests have responded favorably to our simplified product assortment and the compelling values that our season pass products offer. Third, our attendance trends continue to improve, with attendance increasing 6% in the quarter and 4% year to date. Despite a cold and rainy first quarter in California, followed by heavy rainfall in the Northeast and a record heat waves in the South in the second quarter. Fourth, our total guest per capita spending continues to be near record levels. As expected, our admissions per capita is down in the first half of the year as we scaled back our season pass pricing. However, we are pleased that our in-park per capita spending was only down 1% in the first half of the year and is up nearly 50% versus pre-pandemic levels. Our consumer appears to be healthy and is responding favorably to our enhanced in-park offerings, and in particular to our revamped culinary lineup and food festivals. Our guests are spending more on food and beverage this year compared to last year, both in total units and average price paid. Finally, I am proud to say that our team continues to stay focused on costs, with our operating costs up less than 1% in the first half of the year, despite inflationary pressures as well as our investments in advertising and in the guest experience at our parks. We are still in the early stages of our transformation, but we are encouraged by the recent proof points that our strategy is working, and we are excited about the opportunity to take this company to the next level. Before turning it over to Gary, I would like to highlight an encouraging data point that speaks to the strength of our new business model. Adjusted EBITDA achieved by our North American operations, which excludes international licensing revenue, increased 16% in the first half of 2023 versus the same period in 2019. Said differently, we are performing better in the first half of this year on 32% less attendance. While many challenges lie ahead, we are encouraged by our year-to-date results, and we believe we have laid the foundation for many years of organic earnings growth in a healthy and sustainable manner. Now, I would like to turn the call over to Gary to discuss the financial results for the quarter and our outlook for the remainder of the year. Gary?
Thank you, Selim, and good morning, everyone. I will start with attendance, revenue, and per caps, then transition to expenses and EBITDA for the quarter and first half of the year. I will then move on to our active pass base metrics, select balance sheet items, and capital allocation. To close, I will provide additional clarity on what we expect for the second half of the year. For second quarter 2023, total attendance was 7.1 million guests, a 6% increase from second quarter 2022. This attendance growth fell short of our expectations due to a challenging weather environment in the second quarter, with unusually high rainfall in the Northeast, combined with a record heat wave in the South. Revenue in the quarter increased $8 million, or 2%, to $444 million. This was primarily the result of higher attendance, partially offset by a decrease in total guest spending per capita of $3, or 5%, versus second quarter 2022. Admission spending per capita decreased $3, or 7%, and in-park spending per capita decreased less than $1, or 2%. The decrease in admission spending per capita was driven primarily by lower average season pass pricing in 2023 versus last year. As Selim mentioned, we have optimized our admissions pricing, which drove pass sales this year and had the expected result of modestly lowering per caps. In-park spending per capita declined versus prior year due to the lower spend on parking, retail, and flash passes as a result of higher mix of season pass attendance in the second quarter 2023 versus prior year. Due to the inclusion of parking and other benefits associated with passes, season pass guests generally spend less per visit on these items relative to single-day ticket guests. This decline was partially offset by higher food and beverage sales in the second quarter 2023 versus the prior year, which was largely fueled by our revamped culinary assortment, as well as our exciting events and festival lineup. On the cost side, in the second quarter, we incurred $38 million related to an upward revision of our estimated liabilities for our self-insurance reserves, primarily associated with general liability claims, which is recorded in our SG&A. This adjustment is not the result of an increased volume of incidents, but rather the broader impact of rising costs of claims driven by various inflationary factors, including increasing litigation and settlement costs, being driven in part by a general trend of higher jury awards. This trend has been affecting many industries, leading to higher settlement amounts and more unpredictable claims outcomes. Our self-insurance reserves estimates are made utilizing our claims data history, actuarially determined estimates, and other qualitative considerations. As a result of the observed pattern of increasing litigation and settlement costs previously discussed, we performed an actuarial analysis during the second quarter which resulted in the revision of certain key actuarial assumptions. We want to clarify that this change in accounting estimate relates to open claims associated with incidents that have occurred across multiple historical periods. For the purposes of reporting cash operating and SG&A expenses and adjusted EBITDA, we have excluded the $38 million associated with the change in estimate of our self-insurance reserves, as we feel this is a better reflection of underlying operating performance in the current period and provides more meaningful comparisons to our historical results and to other companies in our industry. Cash operating and SG&A expenses were up less than 1% year-over-year. The impact of higher inflation and higher media spend was offset by our cost-saving initiatives and lower full-time headcount. Adjusted EBITDA for the quarter was $161 million, a $7 million increase, or 5% compared to second quarter 2022, driven by higher revenue. For the first half of 2023, our attendance increased by 4% and our total guest spending per capita decreased by 3%, driving a 2% increase in our total revenue. Cash operating costs for the first half increased 2% and adjusted EBITDA increased $6 million, or 5%. As Selim mentioned, we have seen significant growth in our core North American parks compared to the first half of 2019. Adjusted EBITDA attributable to international licensing decreased $24 million from the first half of 2019 to the first half of 2023. So adjusted EBITDA achieved by our core North American operations increased $19 million, or 16% in the first half of 2023 compared to the first half of 2019. Our active pass base as of July 2nd, 2023, comprised 4.6 million pass holders, which includes the new Six Flags Plus subscription program, representing an increase of 2% versus the same time last year. Deferred revenue as of July 2nd, 2023, was $177 million, up $6 million, or 3%, compared to the second quarter of 2022. The increase was primarily due to the higher active pass base as of July 2nd, 2023. Total capital expenditures for the quarter was $42 million, an increase of $16 million compared to the second quarter of 2022. For the first half of 2023, capital expenditures was $67 million. We expect our full year 2023 capital expenditures to be approximately $170 million to $180 million, which includes a mix of exciting new rides, continued infrastructure improvements, and implementation of guest-facing technology and amenities in our parks. Our expectation increased from a prior estimate of $150 million due to higher advance spend on marketable capital planned for future years. We are also raising CapEx expectations in future years. For 2024, capital expenditures are expected to range between $200 and $220 million, and CapEx in 2025 is expected to be between $230 and $250 million before returning to a long-term run rate of approximately 10% of revenue. We have exciting new rides in the pipeline, and we look forward to providing you an update in the near future. Our liquidity position as of July 2nd was $362 million. This included $310 million of available revolver capacity, net of $21 million of letters of credit, plus $52 million of cash. In the second quarter, we successfully increased our revolving credit facility from $350 million to $500 million, which provides us greater capacity and flexibility to pay down debt in the coming years. During the second quarter, we paid down $94 million in debt, and we have paid down an additional $50 million of debt since the end of the second quarter through today. We will continue to use free cash flow to pay down debt and reduce net leverage towards our target of between 3 and 4 times. Before I turn it back over to Salim, I want to highlight a few items to help set expectations for the remainder of the year. First, we expect attendance to increase in the back half of the year, driven by an easier attendance comp in the third quarter. July attendance increased 11% versus prior year. We expect total guest spending per capita to decrease year-over-year due to lower average season pass prices in 2023 versus prior year, as well as to the slightly negative impact of higher season pass attendance mix on in-park spend. We expect cash operating costs for the full year to increase by approximately low to mid-single digits as we battle inflationary pressures while continuing to invest in the guest experience and advertising, partially offset by our cost reduction initiatives. Due to the timing of advertising spend and expected attendance growth, the increase in expenses will likely be more pronounced in the third quarter. For the full year, we are currently tracking behind our previous expectations due to the challenging weather conditions experienced in the first half of the year. Looking ahead, our strategy is gaining traction, and we have many initiatives in place to drive earnings growth, which Salim will now discuss in more detail. Salim?
Thank you, Gary. I would now like to review our 4 strategic pillars to drive long-term sustainable earnings growth, which are park experience, seasonal events, pricing and products, and organizational culture. First, park experience. Over the last couple of years, we have made targeted investments in park amenities, beautification, technology, and new attractions, which have reshaped the look and feel of our parks, and our guests are responding positively. While we have made progress enhancing the guest experience, there is still much to do. Our digital transformation is at the core of Six Flags, providing a seamless guest experience. This is a pivotal year as we overhaul guest-oriented technology and elevate the guest experience to new heights. There are several developments I would like to highlight today. First, we launched our new mobile app in June. We know the parks can be overwhelming at times, so the upgraded app helps guests better plan their day, effortlessly navigate the parks using 3D interactive maps, and make mobile food ordering simple and easy. We are working on many other exciting developments for the app, such as live ride wait times coming later this year, as well as many others we will be sharing in the near future. Second, we rolled out SixPay, our new wristband payment technology at several water parks, allowing our guests to conveniently purchase food and drinks without having their credit card or phone on them. We plan to expand SixPay to all water parks by next season. Third, we are developing Speedy Parking, a new automated service at our toll plazas, providing a dedicated fast lane for pass holders to scan their passes to open the gate automatically. Fourth, we are introducing self-service digital kiosks at many of our restaurants later this year. From my own experience in food service, these digital kiosks result in shorter queues and increase average orders through upselling and cross-selling. Fifth, we are introducing a new automated photo capture solution to provide personalized digital photography and ride videos. Capturing and sharing memories with loved ones is an important part of the Six Flags experience. We have partnered with a leading photography and video company to capture these moments throughout the parks and on the roller coasters. We want our guests to remember the experience because remembered experiences make people want to repeat the experience. And we also want to enable our guests to easily share these memories with their friends on social media. Another area of focus for us is creating fun and memorable experiences for every member of the family to create multi-generational appeal. For parents and grandparents, our rest areas have been well received. The benches, shade areas, VIP lounges, and water park cabanas enhance the comfort at our parks and help reduce stress for families visiting with children. For younger children, we have introduced new kids activities, including pie eating contests, water balloon challenges, and kids rave parties, among other things. We have also installed theme park attractions specifically designed for smaller children, including family rides like Rooker Racer and Kids Flash Cosmic Coaster, as well as the new playgrounds and play areas. In our water parks, we installed new play structures, several new kids slides, and larger thrill rides for older children, like the new Rip Curl Blaster. And for the teens and thrill seekers, we have an exciting lineup of marketable capital for 2024 and 2025, supported by our biggest investment in new rides and attraction in many years. Thrill rides is our DNA. We have significantly increased our CapEx investment this year and over the next couple of years in anticipation of multiple major ride introductions, and we will have exciting new news to provide you in the coming weeks. Turning to seasonal events, we have really upped our game with events this year, but we are just getting started. We recently introduced Flavors of the World, a new food festival with lively street markets and specialty food items like tandoori chicken skewers, pork bao buns, and steak frites au poutine, to highlight just a few. And Summer Night Spectacular, a celebration featuring live music, themed food items, and stunning fireworks and drone shows. This fall, we are investing to enhance popular events that we introduced last year, including a bigger Oktoberfest and a more immersive, kid-friendly Boo Fest. And of course, we are going to amp up our fan favorites like Fry Fest and Holiday in the Park. Exciting news for the horror enthusiast. We have partnered with horror movie franchises The Conjuring and Saw to develop new ghoulish haunted houses in select parks that are sure to be a hit with our thrill seekers. Already, social media is buzzing. And we have some exciting new events to launch in 2024. Stay tuned. Third, pricing and products. We have simplified and optimized our admission pricing. Restructuring our pricing model has been critical in driving an increase of pass sales this year. We launched our new Six Flags Plus in June. Six Flags Plus is a year-round subscription-style pass offering a compelling low monthly payment with no down payment for our guests and has a high average admissions per cap for Six Flags. In my conversation with our guests, they expressed overwhelming interest in the payment flexibility and benefits of our old membership program, and Six Flags Plus has been a huge success so far. We are currently testing dynamic pricing at several of our parks, and while it is still very early, we believe it has the potential to further optimize our single-day ticket sales by adjusting daily pricing based on advanced demand signals. Despite our pricing actions over the past couple years, our prices remain well below our peers. Over time, as we continue to enhance the guest experience, we expect to increase our prices to ensure they are in line with the industry and are commensurate with the value we deliver to our guests. Finally, organizational culture. Very important to me and critical to our success. We are leaner, more nimble, and we have removed unnecessary layers, which has created a culture of ownership among our team members. During my extensive visits to our parks, I interact with our frontline park employees who are friendly and frequently go beyond the call of duty to make their own kind of magic for our guests. They work each day to improve the guest experience with small gestures that bring smiles to our guests. I observe more and more families having fun with their kids and grandkids. I see teenagers celebrating with their friends. They were all drawn to our parks with people they cherish. Ultimately, our success depends on our ability to delight our guests with unique and thrilling experiences they cannot get anywhere else. And our ability to deliver an exceptional guest experience will depend on the engagement, creativity, and collaboration of the talented people across our organizations. Following a year of transition, our strategy is beginning to take hold, and we believe we are now on a sustainable growth trajectory in our top and bottom line. We look forward to updating you on our progress as we strive to continue to improve the guest experience and to increase our profitability over time. Operator, at this point, would you please open the call for any questions?
We will now begin the question and answer session. To ask a question, you may press star, then one on your touch-tone phone. If you're using a speakerphone, please pick up your handset before pressing the keys. To withdraw your question, please press star, then two. At this time, we will pause momentarily to assemble our roster. The first question comes from James Hardiman with Citi. Please go ahead.
Hi, good morning. Thanks for taking my call. I just wanted to follow up. I think you said that versus your previous expectations, you might be tracking a little bit behind. I think we had talked about an EBITDA number this year somewhere in the low $520 million range. Maybe if you can give us an update on that number. Do you still think you'll do north of at least, call it $500 million this year? And ultimately, how do you get there? Obviously, the algorithm previously was sort of double-digit attendance growth, a little bit of an offset from per caps. How are you thinking about those items?
Yeah. Hi. Good morning, James. Great question. The question boils down to how much of the first half weather impact we can make up in the second half, remaining 6 months of the year. And at this stage, that's certainly still an unknown, as it's hard to make up for the lost revenue in the first half. We have challenging targets in the second half, which is built into our original estimate of north of $520 million. Selim laid out a significant number of initiatives that we are all really aggressively working on to collect and see how much of that we can make up. At this stage, that remains to be seen. It remains to be execution, and we need to have fairly good weather, right, to collect what was hampered by the weather in the first half. But I think we're somewhere in the range of 510.
510. Okay, that's helpful. And then, maybe along those same lines, if we could dig in a little bit more on July. I think you said July attendance was up 11%. Is there any way to think about sort of the revenue trend in July? I think versus the street expectations, per caps were lighter than we were anticipating. How much of that 11% was eaten up by declining per caps? And as we go forward, do those comparisons get easier or tougher, right? So if we're thinking about a plus 11 in July, all else equal, does that 11 get better or get worse from here?
Right. So July's per caps are going up against increased pricing in July of 2022. We increased our average prices on passes through August, which was our peak average monthly pricing for season passes. So the per caps will, in terms of admissions, will be a downward pressure on July, offsetting some of that 11% pickup in attendance. So that's kind of where that stands.
Okay. And just to clarify, if I think about that, the downward pressure does that indicate that the per cap decline in July is likely to be greater than what we saw in 2Q?
Yeah. Well, let's just do the quarter. The quarter per caps for Q3 would follow that general trend on admissions. So, down 1 or 2 points on the admission side. The in-park spend will make up some of that. So it'll be Q3. I see the per caps as being down just a little bit more from Q2. Again, that 1-2 point range. And then
Got it.
Q4.
That's really helpful.
Yeah, Q4 really changes the dynamic because the average pass pricing in Q4 in 22 came down quite a bit, and we have a nice inflection point there.
Got it. So Q3 per caps somewhat worse than Q2 before we get somewhat better in Q4.
Right. Yeah, Q4 changes the trajectory.
Got it. Very helpful. Thank you, Gary.
You bet.
The next question comes from Steve Wieczynski with Stifel. Please go ahead.
Yeah. Hey, guys. Good morning. So to follow up on James' question, I mean, as we think about, obviously, weather was extremely impactful through the second quarter. I don't know if you guys, have an estimate of what you think the actual, impact was, or was it just so extreme that it's kind of tough, and given the mix with passes and whatnot, it's kind of tough to really kind of gauge what attendance would have looked like. Or saying that a different way, I mean, if weather, the days when weather has been normalized, has attendance essentially met or exceeded your expectations?
Yeah. Good morning, Steve. The weather hedge that weather impact on our Q2 really feels like somewhere between 5 and 6 points of lost attendance. So, that's kind of where we see that playing out. In terms of when we have a good day versus, a bad weather day, the attendance lift is notable. It's exactly where we are or even exceeds our expectations. So, we use that certainly, and the season pass sales up 50% year to date really give us some guidance as to the second half attendance lift. On good days, we do well.
So if I'm to make that clear, so second quarter attendance was up, a little over 6%. You guys think it would have been more in that, call it 10 to 11% range? Did I hear you right?
That's correct. Exactly.
So that would, that would essentially still, if you kind of normalize that, you guys still would be on that pace for that double-digit increase in attendance for the full year.
Yes. Yes, absolutely.
Okay. Just want to make sure I understood that right. Okay. Second question. So this is probably for you, Selim, but as we think about the increase in your expected capital expenditures moving forward, I'm just trying to understand, why those might be, so elevated moving forward. I mean, you talked about the rides. So is this more ride-related things, or, Selim, as you've dug into the parks, are there just more overall improvements that need to be made at this point versus what you were previously expecting? I mean, in order for you to, to really get the pricing where you want it to be over time.
Steve, that's a great question. First of all, our DNA at the end is thrill rides, and we have to go back and reinvest in rides. So in the last, most probably first 2 years of my tenure, which is last year and this year, we've been very focused on premiumization and beautifications. And I would say one of the reasons that I'm going to digress a little bit. One of the reasons that July was good for us, despite the weather, is the investment we've made in most probably putting more shaded structures, putting on more cooling systems, misters and splash zones, and doing those air-conditioned areas like VIP lounges and others. So those were most probably where we are today. Going into 24 and 25, we're going back to putting new rides in. So a lot of our CapEx will be on exciting rides that gives us thrills. We need to go back, and we're retiring a bunch of rides that have high maintenance, and then we're replacing them with very exciting, thrilling rides, state-of-the-art, new rides. We're putting a lot of money into this. Second, I could tell you, the other thing we need to discuss is our ride downtime. And part of addressing the ride downtime is going back and looking at resolving issues in maintenance and upgrading maybe trains, in making sure that our parts are fully stocked, to make sure that we are always predicting and making sure that we're predicting our maintenance and making sure the rides are up. So it's a combination of maintenance, but it's not the biggest part. The biggest part is the thrill rides. We're having a lot of thrill rides expenditures.
Okay, gotcha. Thanks so much for the color. Appreciate it.
The next question comes from Thomas Yeh with Morgan Stanley. Please go ahead.
Thanks so much. So the acceleration of season pass product adoption from up 2% at the end of June to up 50% in July, that seems to get you pretty close on an overall season pass base to not so far off from where 2019 levels were. It sounds like the price changes you've made incrementally is the right place to be. Is kind of that the right way to think about it? And on an admissions pricing on an apples to apples basis, do you think you can kind of grow this from here?
Yeah, good morning, Thomas. Good question. Our season pass lift in the first quarter year to date. So we're using year to date. So from January to the March is right, April. Thank you, Evan. Was up about 100%, and year to date it's up 50%. I think that's the right metric, and hopefully I've answered your question in that regard. Looking at the pricing, we definitely have optimized our season pass pricing and look at that going forward. 6 Plus has been a really strong success, as Selim indicated. And going forward from fourth quarter on, we have the opportunity to gently lift season pass pricing over prior year.
Okay, that's super helpful.
I just want to further clarify that 2% you're referring to is actually the active pass base, which is up year over year 2% as of June, and Gary was talking about the sales of season pass units.
Understood. Okay, that's super helpful. And then just another one on the cost control side. Where are you finding the most efficiencies? I think you mentioned that inflation's still working against you, and there's plans to lean a little bit more into media spending, just given some of the attractions coming online. Is there still room for more headcount reduction just as the attendance base optimizes?
We're having success in procurement. We're doing a nice job there, working with our suppliers. We have reduced our full-time headcount, but we don't have a significant initiatives in that regard going forward. But our parks are continued to improve their operational efficiencies, and that's where we're seeing our biggest lift in the cost reduction side.
I would like to add also that our procurement has been very, very good. We have done a great job in supply chain, and this continues to be something we want to push. I also believe that we have continued to lower some of the headcount through automation and rationalizing our F&B locations.
Thanks. Yeah, thank you, Selim. Absolutely.
Got it. Thank you.
The next question comes from Ian Zaffino with Oppenheimer. Please go ahead.
Hey, great. Thank you very much. As far as the weather comments you made, have you seen any, or have you taken any actions regarding the weather, whether it's on pricing, more marketing, et cetera? And actually, what's kind of your philosophy on pricing in kind of poor weather periods? And then I don't know if you commented at all on July heat and how that was impacting the parks. Thanks.
Yeah, you bet, Ian, and good morning. So the challenges we have there is, Ian, I'm sorry, what was your question again? Forgive me.
So it was basically, what's your philosophy as far as pricing actions, marketing actions in poor weather periods?
Yeah, thank you. No,
and then also July heat and August heat. Yeah.
Right. So one of the things we have had success with, and it's still early in the stages, is dynamic pricing. And we had started with 3 parks, and we've expanded it to 6. So that it actually, dynamic pricing in its own way acts as a weather hedge, which is pretty nice. And the next fairly significant step we need to do is increase the active pass base, right? So a larger active pass base also is a nice weather hedge. So we are, expending more on media in the third and fourth quarters, and we're going after a good sale at the end of August and into Labor Day weekend. And fundamentally, as the weather continues to be hotter every year, it seems, at least it feels that way to me, we are going to be looking at more indoor venues, more air-conditioned venues, more air-conditioned restaurants, et cetera, so that our guests, and Salim, you talked about shade, and you talked about the benches and the trees,
VIP lounges.
VIP lounges, and the gaming is actually a pretty nice initiative in that regard too, because it provides a very nice, cool environment and a whole nother product and marketing initiative that we have. So we're looking at more indoor venues and continued effort on shade and misting equipment, et cetera.
I would also bring up something. I think that most probably something different than most of our other peers is our memberships. I think our membership allow us to counter weather effects, because when you look at membership, which happens, we have been able to still be able to sell membership, whether the weather is whatever the weather is happening, and this has been validated in June, July, since we launched our Six Flags Plus membership. So we see that as somewhat of a hedge in terms of continuing selling passes and offsetting some of single day ticket impact during those days.
Okay, thank you. And then, can you also maybe comment on how the parks, the ex-US parks did, and any potential for, additional parks outside of the US? Thanks.
Ian, what can you clarify? What do you mean U.S. parks did?
The non-U.S. parks. So how did Mexico do? I guess in particular, just given that there's probably less weather issues there. And then the second piece would be any discussions, or are you doing anything as far as developing or thinking about any new parks internationally?
I'll answer the first part of the question. I'll let Salim talk about if we have any additional opportunities internationally. We don't allocate out our international parks in any specific way, Ian, but Mexico is still doing very, very well. So, Salim, the next question for Ian was, do we have any additional international opportunities?
Yes, we are working on our project in Saudi Arabia, which is due to open in the fall of 2024. And it's still being built. And at this moment, we are acting as a licensor of Six Flags to them. And we're, at this moment, waiting for the project to be working open. So we are at the last stage of it with our team, working along with the Qiddiya team in Saudi Arabia, and we're very excited about that project. So more to come, most probably in 2024.
All right. Thank you very much.
Thank you.
The next question comes from David Katz with Jefferies. Please go ahead.
Hi, good morning, everyone. Thanks for taking my question. I'd love just a little further perspective in view of the increased spending for next year and the year after, is it possible or fair for us to think about EBITDA lifting along the way? I'm just trying to envision the capital setup, as we move into that spending period the next couple of years.
I can answer that. I think, David, we've done a lot of work on the cost discipline and allowed us also to invest in the guest experience while still eliminating inefficiencies that are costly to the business. We are also looking at data and predictive analytics to reduce labor costs and implement process improvement without negatively impacting the guest experience. I think we are investing also in technology and automation to reduce operating expenses. So CapEx on infrastructure and replacing inefficient rides will also reduce expenses. Those rides have high maintenance. So my feeling is operating leverage efficiency as attendance grows to target levels will allow us to increase margin over time. So I believe we can grow margin into the mid 40% long range term, and that's our objective.
Right, modified.
Modified.
Okay,
modified EBITDA in the mid 40% in the long term.
Understood. But in part, I suppose, of that formula, is there a potential for revenue lift along the way as well in driving that EBITDA, or does that CapEx necessarily need to be in place before the revenue lift can occur also?
So, David, a fair number of our installations this year in 23 have been delayed in their installation construction progress. And so those are going to hit at the second half of this year, and into 24 we'll have the full impact. So between that and what we're doing for 24, and we have a better execution plan on installing the 24 rides, and we have a little more time to plan to get it done. So the two are going to actually work simultaneously together to provide a really nice package improvement for our guests. And I do believe we can increase revenue on our.
I would like to most probably add a little bit more flavor on that.
Yeah.
I think on one end, I think we've seen that our pricing structure that we've started in the fall has started to pay off with the season pass increases we've had. So let's put basically admission on one side. Let's talk about the in-park. I believe that our biggest opportunity to monetize an in-park goes into two areas. F&B, which remains, in my opinion, at this moment in maybe 20% of our penetration. And I would like to see that a third of our revenues. And I think we have a lot of things going there. Number one is mobile food ordering. Second will be self-serving kiosk, making sure that our seasonal events that have basically upped our per cap this year, when they are done well, events done well, have upped our per cap. Then on the retail side, I think the retail is our second biggest opportunity. We are putting a complete retail strategy to improve our sales in that area. And finally, I would add a third one, group sales. I would say when it comes to group sales, I think we have a huge opportunities to continue to grow that opportunity. We continue to be below pre-pandemic levels, and we are in line in what we saw last year, but we have not gotten to pre-pandemic levels. So we're putting a strategy to grow our group business, and we feel better by engaging local businesses to come and experience our parks. So three initiatives that I see driving a big part of our EBITDA margins: F&B, retail, and group sales.
Got it. Thank you very much.
Thank you, David.
The next question comes from Lizzie Dove with Goldman Sachs. Please go ahead.
Hi there. Thank you for taking my question. I just wanted to ask bigger picture. You've been working through the premiumization strategy. I think your goal was to get to that 25 to 27 million level of attendance over time. Clearly, it's been tough with the weather. There's been some commentary about weaker per caps, not just from you, but, the other regionals, even Disney last night. We're in a different world today. Has anything changed about your kind of pricing versus attendance formula going forward? Or do you think those are still the kind of right puts and takes and levels going forward?
Good morning, Lizzie. Thank you. Good question. I think we have a powerful opportunity to show the viability and future opportunity of this strategy that we are executing upon. And when you look at pulling out the international licensing and that we've exceeded 2019's EBITDA in the first half by 16%, it really gives us a base from which to launch from. And as the season pass pricing in 22 comes down in the last 4 months of the year, we cross over and we start having increased average season pass pricing on a monthly basis going forward. You combine the capital into this marketable capital that we're going to have some exciting announcements in the next couple of weeks, and you have the cost structure reset. You put those all together, and we really think we have an ability to capture future attendance, and the enhanced value will be perceived by our guests, and we'll have in-park spend, and we eventually can get there. So when it happens is a basis of execution and time, but we firmly believe we're on the right path.
Thank you.
The next question comes from Robert Aurand with KeyBanc Capital Markets. Please go ahead.
Hi, thank you. I guess following up on that last question on the longer-term outlook, in the past you've talked about that as kind of a 3-year turnaround, understanding kind of the speed bumps of this year. Is that 3-year target still intact, or do you see it getting pushed out at all?
I would still say that the 3-year target is, I extended it, if you remember, last year to end of 2025. So if you remember, I have said that the target is most probably we'll try to achieve our target of being close to $700 million in EBITDA by end of 2025. And we're still looking at that as a target for us, yes.
All right, thank you. And then maybe a higher level question around the new membership program. I know you had said last call that was the number one question you were getting from people was to bring back the membership. Now you've brought it back as kind of a one-size-fits-all option, where before you had many different memberships. So understand the simplification on your end, but how does that kind of sit with the consumer now, just kind of having the one option to choose from?
Well, I can answer that. Guests have responded very positively to the release of our new Six Flags Plus. So we started it in early June. We are seeing a similar mix in sales of Six Flags Plus product versus traditional season pass as we had in prior years. About a third is similar to what the legacy membership used to be in the past. A third of our sales are coming from membership right now. And we just started selling them in June, so it will take time to rebuild that base. Now, we should not forget that we grandfathered the membership program, the old legacy membership. So I think I will be able to give you a lot more color on Six Flags Plus is most probably in the first quarter of 2024. But we're seeing good results so far in the first 40 days, 45 days.
Perfect. Thank you very much for taking my questions.
Thank you.
The next question comes from Carson Crockett with Rosenblatt. Please go ahead.
Hi, it's Barton Crockett, and thanks for taking the question. And I just wanted to drill in a little bit more on July, and I think the question was put out there, but I'm not sure I heard it answered, which is, was the weather in July, when you guys had this nice kind of acceleration, Was weather better? Was that part of what helped? How would you describe the weather backdrop in July?
From my perspective, Barton, it was better, but not great. And I think there's more upside to that 11% with normalized weather.
Okay. And then also leaning into the CapEx plans, I think you guys as recently as like your March earnings call for the fourth quarter, we're talking to a range of like 150 to 200, and now you're up to like 250 at the high end for CapEx in 24 and 25. Can you walk us through kind of the process that got you to decide that you need to spend more in that period? Was a decision that you need to just, and also it seems like the tone of what you're talking about with CapEx. I mean, when you started, you were talking about less emphasis on the rides and more on kind of just a comfortable kind of, amenities and the benches. And now it's more kind of on the slow rides. So just walk us through kind of, the process and what's changed in these intervening months to get you from where you were to where you are.
Yeah, thank you, Barton. Good question. The lift in 24 was somewhat related to, we have a 50th anniversary coming up at our park in New Jersey, and we had an opportunity to add a nice ride kind of late in the game, and that's a little bit rare because it takes generally a while to design and build a coaster. So we had a fortunate opportunity, and we decided to take it. So that's the lift versus what we had expected to spend in the short run. In the long run, we're looking at all aspects of the CapEx, and Salim laid that out fairly well in a couple of questions ago. We want, the focus is eliminating ride downtime, and sometimes that's maintenance and new trains and new parts and all that sort of thing, and sometimes it's replacing an aging ride. So we looked at that very closely, and we're also really trying to enhance the customer experience through the CapEx investment, and we feel that it will really bring additional attendance and revenue and excitement, and ultimately bottom line profits to our investors and shareholders.
So it sounds like you just leaned into it more and you decided that this was the number that made more sense.
Yes, and in looking at the ride package, which we will announce over time, as Salim mentioned, there's some of the rides state of the art, and state of the art is generally expensive. So as we look into it and we say, yes, that's a great ride. Yes, it fits in that park. Yes, it's the right metric. Yes, it's the right dynamic. And wow, okay, that's what it costs. All right, and we all agreed that was the right thing to do.
Okay, thank you.
This concludes our question and answer session. I would like to turn the conference back over to Salim Bassoul for any closing remarks.
Thank you very much. Once I want to thank everybody for all your questions and your interest in Six Flags. I would like to recap my talking points with a concluding statement. Six Flags has a strong position with a very attractive industry. We talked about our 4 strategic pillars: our park experience, our culture, our pricing and product, our seasonal events. So when you look at all what has been accomplished in the last 20 months since I took over as CEO, we have basically implemented a lot of new items, from doing our events better and stronger and new and immersive, like Scream Break, like Flavors of the World, like Summer Night Spectacular, including fireworks and drone shows, parades, Gaming Fest. And now we're enhancing what we started last year, new Oktoberfest, Boo Fest. And then we're expanding on the best Halloween event in the world, Fright Fest, and then HIP Holiday in the Park. Through our park experiences and the improvement in our premiumization, we've seen improvement in pass sales, 50% year to date through July. Attendance, 6% in Q2. Our F&B is up despite poor weather. We lost in 2Q almost 400,000 in attendance. In our pricing and product, we launched again. As we listened to our guests asking us to bring back a low monthly payment with no down payment, we launched a Six Flags Plus, which so far in the first 45 days have been very well received. Our culture has changed. Innovation now is our core. We have a lot of digital transformation, which has become seamless to our people, and we could not have done that without the hard work of our team member. Our parks have become friendlier, cleaner, and a lot more smiles. Our seasonal worker and our frontline employees at our parks have embraced the vision and embraced the fact that we want to be easier to do business with. I applaud each one of them. We are seeing promising trends despite weather challenges. Again, strong pass sales, 50% year-over-year through July. Attendance trends are improving. Q2 6%, July 11%, improving F&B, improving sponsorship sales. Our digital transformation, driving our guest experience and lowering our costs. Our ability to now capture memories through videos and photos using artificial intelligence and be able to capture people on the rides as they are riding our coasters. Self-serving kiosk, speedy parking, water park wristbands, a new mobile app, and a new website. All of those have happened at a fast speed of execution. Kudos to all our teams. We've gone to multi-generational appeal. We want to be able to appeal to kids' activities, kids' ride and play structure, comfort and shaded area and VIP lounges for parents and grandparents, thrill rides and new haunted houses for our thrill seekers and teens. And then we want to capture all of this on video and picture, and they can stream them all day long. Immersion. I believe that remembered experience bring repeated visit. We want to engage all of our senses. Our guests now want to go and experience our Dino Adventure, a Scream Punk, as we expand them throughout all our parks. We have exciting new revenue initiatives, dynamic pricing, increasing mobile food ordering, seasonal events, and e-gaming. On our cost control, we continue to be driven by cost discipline, automation, reduced downtime, procurement, committed to deleveraging our debt. We look at a target of 2.5 to 3 times long-term net leverage target. We paid $94 million down in Q2 with an additional $50 million paid down through today. Almost $150 million paid since the beginning of Q2. Our second half expectation, low to mid percentage per cap decline. Active pass headwinds, more media to launch our fall promotion. Remember, last year we did not have a good fall sale. So now we're trying to put media behind it and go back to having a good fall sale promotion. Our CapEx of $170 to $180 million. Now, we do not give EBITDA guidance, but we do not expect to make up weather-related losses. Our ultimate strategy is focused on delighting our guests. I have spent enough time analyzing our offerings and operations, traveling around our parks to observe guest behaviors and talking to our fans to uncover hidden opportunities. You did hear today on how we are innovating across every part of our business, from culture, digital training, revenue management, guest-facing technologies, immersive experiences, rides, beautification, food service, retail, and much more. Success requires not just leveraging your strengths, but also taking risks, overcoming challenges, and learning from failure, evolving your vision, and sometimes reinventing yourself. That is true for both our organization and our leadership. We are excited about our momentum. On behalf of the Six Flags team, we appreciate your continued support and the support of our shareholders and investors, our guests and fans, our suppliers, our bankers, and most important, the support of our team and our employees, who without them, nothing could have happened. We have many exciting events lined up for the second half of the season, including Fry Fest, Kids Boo Fest, Oktoberfest, and Holiday in the Park. We still have 40% of our revenues coming still so far. And we hope to see you at all those events this year. Have a great day, and we look forward to speaking with you next quarter. Thank you.
The conference has now concluded. Thank you for attending today's presentation. You may now disconnect.